Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and joining me in the studio, we have Dale Colclaser. He is the president of Wealth Management, and co-founder Mark Smalling. The title of today's show is How to Remove Your Wealth from Washington. If you are uncertain about what your tax burden might be in retirement, if you're wondering how you can lower your tax liability today, you are not going to want to miss today's show. Mark and Dale, it's great to be back with you. How are you both doing?
It's great. It's great to be back with you again this week.
Thank you. I know you've been so busy meeting with a lot of folks who've been calling in from the television show, and it's really exciting to see how you're able to make that connection through the screen, and then folks come in to meet with you, and you're able to help them. It's just a beautiful thing.
Well, I mean, I love the idea that we're talking about taxes today, because that seems to be the biggest response aspect that we get.
Yes.
I think because a lot of people that believe they're working with an advisor, they've got somebody they've been with for many years, and they begin to realize that maybe they've done a good job in some areas, but they begin to realize the concept that they're not holistic.
Right. Well, this tax conversation is often a piece that unfortunately gets left out of the equation, but I know that you really spend a lot of time engaging in strategic tax planning for your clients, so we're going to get into all of that today. You know, it's so frustrating when you have worked and saved your hard-earned money for all these years, only to see your retirement be eroded by taxes. And there's actually a lot of strategies that are available to help you begin lowering your tax liability even today, no matter where you are on your retirement journey. So that's why we wanted to dedicate this show to that conversation. There's lots of categories of income that are not taxable. We're going to be going through a list of that today. But before we dive into some of these common types of non-taxable income, I think it's important to just upfront establish two things. So my first question is, why is it so important for folks to understand their potential tax burden in retirement? A loaded
Where do you
question.
start?
I know, right?
Christian, I think the main thing is for everybody to realize that you're going to be more efficient simply by having some kind of plan, even if it's not the best plan, because taxes are one of those things that our education system has, I'll just be candid, has failed us on. Most people have no understanding of what their taxes are.
Yep.
So many common times we'll ask people, so what are your taxes? Oh, it's awful. What is it? Why to pay in? Well, what do you mean? And they go, oh, well, when they calculated my taxes, I still had to pay in after they withheld everything. And I was like, well, do you know how much you paid in? Well, all they know is that check they had to write. They have no concept of the total amount of tax bill that they have, because we're just taught that it's just what it is.
Right. And a lot of people just think, okay, well, I guess I just have to do it, right?
That's right.
And we're not talking about tax evasion, but we're talking about tax mitigation, right?
That's
correct.
That potential tax
When
bill.
we have people come in and they say, oh, I'm in a 22% tax bracket. They think they're on a 22% tax bracket on the whole amount.
Yeah, for every dollar.
They don't understand how the brackets work and how they gradually step up, and that you only pay that amount in certain brackets. So there really is just a huge lack of education.
For sure. Well, and to that point, I've heard it said that there's actually two types of tax codes happening today. One for the informed and one for the uninformed. And we want to do our best to make you informed.
Yes, ma'am.
So the second thing I think it's important just to establish up front is that you all are not CPAs. You're not accountants.
That's right.
You are financial advisors, but you specialize in engaging in proactive strategic tax planning for your clients. Talk about that difference.
So the idea is for a quote to be a tax professional, typically we're going to refer to as a certified or a certified public accountant. That's going to be someone who is going to account. Maybe they do a lot of accounting for your business, and then they're going to be experts in tax preparation. So tax preparation is accounting for what I've already consistently done in the past, not necessarily proactively looking forward. And in so many cases, people say, well, doesn't my CPA do that for me? And my typical response is, did you ask them to? And they go, well, no, I just assumed. And well, we know what happens when we assume things, is that they typically don't happen.
Right.
But it's just this assumption. And what I'll say is that CPAs do a great job at what their job definition is. There are some that go proactively and look forward, but that is not typically the case. So what we're attempting to do is to affect the impact of taxes on us, not just in the current year, but next year, 10 years, 20, 30 years down the road.
Right.
So there's strategies that we can implement today, especially if you're, again, we'll use the term that I've been fortunate enough to accumulate a substantial amount of assets, and there's money that I'm never going to spend. I know this is going to the next generation. There are certain strategies we can implement today that we can never use the word guarantee, but that I can almost assure you are going to have a lower effect of taxes on your your overall wealth accumulation over time than not doing things a certain way. Again, we very rarely plan to pay taxes today so our kids don't. We're just simply trying to put together an efficient plan so the money that you've put together gets utilized in the most efficient manner possible.
Right. And you know, an analogy that has always stood out to me when you were talking about what the job description of a CPA is, it's like if you're driving a car, they're looking in the rearview mirror. They're looking at what happened last year. They're looking at how to save you taxes from what happened last year. That's a historical look back, right? Strategic tax planning is looking through the windshield of the car, to your point, looking ahead and really making strategic plans and choices now to create greater tax efficiency throughout the full financial plan that can have ramifications for years to come.
Right, and the proactivity of that, actually looking forward and making that part of your income planning every year, and also not just looking at today, as Dale was saying, looking years out. What do we do today? Because people think about diversification in their portfolio, but they don't think about tax diversification, and that's something that we really stress when we're meeting with people.
Yeah, so important. Well, we need to start working our way through this list of non-taxable income. Of course, today's show is titled How to Remove Your Wealth from Washington. And at the top of that list is Roth income. Let's talk about that, because that is a huge strategy. You know, folks either contributing to a Roth or doing Roth conversions. So can you unpack that a little bit?
Well, the main thing we want to point out is having balance and having diversification and options. So there's some of these, again, rules that we'll go and refer to as we've done over time, that if I'm in a certain income tax bracket, Roth makes sense over others. If I'm in, if I make a certain amount of income, this doesn't. And if I'm a certain age, some of these things don't matter. And the reality is those are just not conclusive rules, is that it completely depends on my situation. And so most of the folks we're talking to obviously today are going to be to that latter stage of the accumulation world, more looking into the distribution phase. And so Roth conversion may be another great concept. We'll just give a realistic story that we've had just the past week in our office, where we had a prospect that came in and she had been doing had been making Roth conversions to the maximum in her 403B plan. And somebody simply said, and she came to the situation where she was needing a little more money in her monthly cash flow.
Right.
And somebody says, well, why don't you just switch back and do the pre-tax contributions? That will net you another $500 in your payroll because of the taxes that you're paying today won't be withheld.
Right.
Logical sense, right? I mean, that makes great sense. She needs more cash flow. Where when we came in and then basically drew up a plan for her to show her how she could continue to make the contributions through the Roth plan, let's just decrease the amount that we're contributing. Because what the logical consequence today was missing is the foresight of having all of those dollars in a Roth account later to be able to utilize. And the reason is this lady is in a government pension situation to where she's going to have a set amount of income every single year that puts her right at the threshold of the 12 to 22% income tax bracket for a single tax filer. And the idea was that's still not enough money for what she needs to live on.
Right.
So we show her how having and being able to distribute money up to that threshold in a pre-tax account, which is taxable when she does that, and then taking additional dollars out from her Roth account or for some other non-qualified fund is a more efficient distribution stream in that time frame.
Right.
And then over a 30-year time frame, it increased her total asset accumulation by $400,000 or $500,000 over time. And she goes, oh, okay.
Yeah.
So sometimes it's not the most obvious immediate answer today that is the best choice to make.
Right. Well, I'm sure that just blew a lot of minds to hear you share that story, right? Because historically we were all told, oh, you have a 401k, you have a 403b, you have traditional IRAs. This is a really good thing for you because you put the money in today, you're going to get a tax break today, and you don't have to pay taxes till retirement, and supposedly you're going to be in a lower tax bracket when you retire. Right. But times have changed.
Well, they have, and that's one of the huge misconceptions people have about retirement is that there's actually a different tax code. Right. Tax brackets for you when you retire, and that's not the case. And so if you're confused about taxes in retirement or preparing for taxes with an upcoming retirement, we'd love to have you come in. Let's help you evaluate your situation, look and see if we might be able to find some tax strategies that might work for you.
Wonderful. Mark, Dale, thank you so much. If you are prepared to have your mind blown for you to be able to lower your potential tax bill in retirement, we encourage you to call the number on the bottom of your screen to set up a time to come in and receive your complimentary written financial plan. Again, this is for no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how the team of Retire Path Wealth can help and serve you. That number to call is 866-724-3893. Or if you'd rather not talk to someone right now, but you do have your smartphone handy, if you simply pull it out, open up that camera app, you can point, click, and scan the QR code that you see there on the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to you to schedule your complimentary visit that way as well. More in this important conversation of how you can remove your wealth from Washington right after this.
We're based in Little Rock, Arkansas. We're licensed literally in 37 states, though, so we can reach across the realm. The greatest benefit of being independent is simply choice, but always having basically the entire investment universe to go search for the best answers for individual clients and then helping to narrow that down. We do a very solid job up front in our data gathering process of not just getting information, but getting a sense of feeling what a client's real objectives and long-term goals are based on where their finances are. From years and years of doing what we believe is simply doing the right thing, we're going to find and get that answer for you, not, hey, here's someone else you can call, see if they can answer this question for you. We like to have those resources on hand.
Welcome back, Arkansas. You're watching Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, here with both Dale Colclaser and Mark Smalling. Today's show is all about how to remove your wealth from Washington. If you are looking for ways to reduce your potential tax bill in retirement, that is what we are getting into today. And I want to go back. We brought up the subject of Roth conversions in the first segment. There's a lot of confusion surrounding this strategy. There's a lot of misinformation out there. Let's really break it down for folks and just for our viewers to understand, okay, what is a Roth conversion and could it possibly be the right strategy for me?
I appreciate that lead in. Roth conversion by definition is simply taking money that is in a pre-tax, tax-deferred, taxable account, a traditional 401k, 403b, or any of those other acronyms that go along with it, or an IRA can be. But if I'm in a qualified plan, I've got to first make a step to move that to a traditional IRA account. So I've got to have money in a position to where I can get it to the IRA account, first of all. And so if I'm working, I may be limited. If I'm 59 and a half, I may have an in-service distribution option. If I have an old 401k plan, maybe that's the best dollars to work with. But then I actually make a distribution from that traditional IRA account. I make the money taxable, okay? So the first thing I want to point out today is there's going to be some pain with this one. We're going to pay some taxes today, but we want to be able to show you the value, okay? And I'm going to stress the value in paying taxes today at a potentially lower bracket, and then allowing that money to grow tax deferred and come out income tax free later when potentially we're in higher tax brackets or we have a greater time frame to stretch the distribution over.
Right. Yeah. It's going from taxed later to taxed never, right?
Well, that's right.
And here's the other one, Kristen, that I think often many times gets missed. If we have money that we know we're never going to spend and we're going to pass this one to the next generation, I may be having the opportunity to now leave money to my children that they're not going to be taxed on when they receive it, not taxed on it for an additional 10 years after that. I don't know of any other account that allows me to do that before they have to take the money out, tax-free still, but then turn around and make it taxable moving forward. But that I get to defer those taxes even past my death.
Right.
And oftentimes people misunderstand that, if they're at a certain income level, they think, I can't make Roth contributions. A Roth conversion, there is no income limit on that.
Real live client story again, since we always love to do those. We've got a gentleman who's in the midst of a career change.
Okay.
And so he's gone from a higher income position to, for a number of years while he's in school, is going to be in a much lower tax bracket. And so the idea is we're currently putting together a strategy for him to convert all of his existing funds while he's in this lower income bracket before he goes back to work at a much higher income now.
So smart.
To allow all of those dollars to build out. Now he can then go back to making those pre-tax contributions once he goes into a higher tax bracket, but he already has that tax balance bucket built.
Right. So smart.
And the change is just phenomenal.
Yeah, absolutely. Well, the reality is we could do an entire show just on the subject of Roth conversions, right? That's just one strategy. Let's move on now down the list and talk about some of the other ways that folks can potentially reduce their tax bill. First up, of course, we're looking at types of income the IRS can't touch. Financial gifts. Let's talk about those.
Yeah, so currently for 2024, you can make $18,000 gifts to, and that, so if you're a married couple, to anyone, and
that's per person.
That's
right?
per person.
Yeah.
That's per person, and that's that's one way that people could
And many times that money is gifted into a child's name in a situation where children have less or no income.
Right.
And so if we can put those in long-term capital gain type assets, then maybe that child doesn't pay any taxes on the growth of that money as it grows through their earlier years. Sometimes you can get the same advantage in an UGMA account that's been gifted as you could in a 529 plan possibly.
Wow. Yeah. So good strategies to know about financial gifts to friends and family. Let's talk about now to charitable places, right? So making those charitable donations.
Yes, even better. And this conversation comes up a lot more with the new higher standard deductions that we have in place, at least for the next 2 years. And then, of course, we don't know what happens after that point. But the reality is that most people have a mortgage that has an interest rate that's so low that they're not able to itemize their contributions anyway. And so if I am literally 70 and a half years old, the old original RMD age, I may have the ability to make charitable contributions directly from my IRA account. They circumvent my tax situation and go directly to the charity itself.
Yes, those are known as QCDs.
Qualified charitable distributions.
Thank you. And so that's a tax efficient way to distribute that income. And also in many cases, I also may have the opportunity to utilize a donor advised fund, which is a very underutilized tool today, where I can make multiple years worth of charitable contributions into an account, and then I get the full tax deduction in today's dollars, and then I can distribute that income out to the charity over the next couple of years.
Amazing that there's so many strategies available, and these are all legal ways. This is written into the tax code.
Yes, ma'am.
It's
Absolutely.
just going back to that, what we said at the beginning, a lot of folks are just uninformed about how to utilize these strategies.
Well, and sometimes even too, if I have dollars and I'm charitably minded, I just plan on leaving some of those qualified dollars, whether by beneficiary designation or by trust, directly to that charity itself, and then leave the other assets to my children.
Right. Amazing that can happen. Next on the list, life insurance proceeds. Talk about how that can be a tax saving strategy.
Yeah, life insurance is one of the oldest codes on the book. It's been around and been used for centuries, and so you can, not only is the death benefit non-taxable as long as it's set up appropriately, you can also get cash out of it, to help with your income if it's taken out in the right way too. So there's lots of ways to do that, and if you see, there's a lot of most Fortune 500 companies have it set up for their executives. Most politicians have it as part of their portfolio.
All the basketball coaches?
All the basketball coaches, all the football coaches. If you see these big contracts that they sign, they're all set up with some kind of provision with large cash value life insurance contracts.
It can also be one of the most efficient ways to address long-term care concerns today too, is through life insurance. And so if you're looking for tax strategies today of ways to reduce the effect on your earnings and your income in retirement due to tax minimization, there's some concepts that maybe you haven't thought about before, or you just know there's something else possibly better than what I'm doing out there, please give us a ring. Let us walk through your situation, show you some specific options that may make sense to you and allow you to make a best decision on ways of decreasing your taxes in retirement. Because always remember, taxes are going to be the largest fee you're ever going to pay on any investment out there.
Well, Dale and Mark, thank you so much. I'm glad we're having this conversation because nothing is more tragic than watching someone's retirement get eroded unnecessarily because of taxes. But with proper strategic tax planning in place, you can help to reduce that potential tax bill for yourself in retirement. So we encourage you, pick up the phone and call 866-724-3893 to schedule your time to come in, meet with the team of Retire Path Wealth, and receive your complimentary written financial plan. Or again, you're also welcome to scan that QR code and that will get you connected as well. More on this conversation of how to remove your wealth from Washington right after this.
We take the planning seriously. We run all the numbers, gather all the information.
I mean, I've heard of firms calling 70% outcome, goal achievement. Hey, we're there. Well, when I went to school, a 70 was a C-. That's not how I want to walk into retirement.
Everything we do from a planning perspective at Retire Path, we take the fiduciary responsibility, not just with the finances, but with everything, trying to put you in the best place possible for yourself. A successful retirement to me is not having worries about where dollars are coming from or about your health coverage.
Tax code's going to change. Medicare is going to change. Social Security, it's going to change, folks. You want somebody that's going to understand how those changes affect everything else as you move along. That may be great general advice, but it has nothing to do with your personal situation.
I mean, to literally see people come in the office that are scared and there's a lot of trepidation, and having them leave with that weight lifted off of their shoulders.
Let's get your data in, allow us to analyze your situation, and see if we can be a valuable partner in your financial life.
Making sure that everyone that comes in to our office leaves feeling like they've received something of value from us. Retire Path is a unique place because we built it from scratch.
Welcome back to Arkansas Money Talk, where today we are talking about how to remove your wealth from Washington. My gosh, there's been so much already we've covered in today's episode. Lots of ways for you to potentially lower your tax bill in retirement. Moving on down the list, I know that there is another type of non-taxable income we got to talk about. Some capital gains and some capital losses. Talk about that.
Right, so the idea here is where we want to stress different type of investing and different type of account structure, where if I'm in a non-qualified type of an investment, okay, and again, hate to use the jargon, but the idea is we've already paid payroll taxes on this income, it's coming to my checking account, and then I'm just going to go out and purchase something.
Right.
I want to, if I'm in a lower end of a tax bracket, it really doesn't matter anywhere, it's just more advantageous. But if I'm in a 12% or less tax bracket, long-term capital gains and qualified dividends are currently taxed at 0%. Okay, zero is zero. Okay, the idea is it's taxable, but it's taxed at a zero bracket. So I want to be very cognizant of how I set up those non-qualified investments. Inside of the IRA account, we don't really care about that kind of structure because the only taxation is when that money is distributed from the account. It doesn't really matter what happens inside of it. Again, one of the things, as we mentioned in an earlier show where we were talking about how we like to use ETFs and things that we can control the structure as opposed to mutual funds, is because I'm going to be subject to what the mutual fund manager does. I don't find that out typically until about the third week of December, and they go, oh my gosh, now I have this other tax bill that I didn't count on.
So important to engage in that strategic tax planning.
That's correct.
For that perspective. It's interesting, we talk a lot about diversification in financial services, right? But it's tax diversification, right?
That's right.
It's
Yes.
important to have, making sure your investments are well diversified from a tax perspective, for sure.
Right.
Yeah.
Well, and again, the other thing we didn't touch on there is the idea of the opposite side of capital gains is capital losses.
Right.
So there may be a reason to go in and reallocate those accounts and harvest some of those losses against gains where we can kind of offset the consequences of those taxes. Folks, that takes a proactive approach
Absolutely.
to do that.
It does. Well, we want to keep moving down the list here. Annuities. Talk about the potential tax savings of using in a vehicle such as an annuity.
Well, with annuities, when you put in, let's say if we're using it for non-qualified, so we've already paid taxes on it, as long as we're not taking income out of that annuity, we're not paying taxes on the gain in that. We only pay taxes on it as we take it out. If it's in an IRA, it's going to be taxed just like it would be in any other IRA, just as regular income as it comes out of that. But in a non-tax qualified situation, we can actually defer that income until a later date. And so unlike your account at the bank where you're receiving interest every year, you're not paying taxes on that interest as we go along. It's only when we take it out, and it's only on the gain on that account.
Now, using an annuity non-qualified account, we want to be very pointed to what our effort is here.
Right.
Use a real life story. We had a client. They were excellent savers their whole life, and they basically got to a situation where their Social Security income was all they needed. But they had these accounts out there that are literally generating an additional $100,000 to $250,000 a year in income that they're having to pay taxes on. And so, in part of our discovery process, Mark asked, "Well, what's the purpose of these assets?" And she goes, "Well, I'm leaving those to my college." Okay, we're going to leave those to a charity that doesn't pay taxes. What if we reposition at least a portion of those into something to where you're not paying taxes today or next year or the rest of your life? We're going to get some type of a guaranteed growth situation. We leave that then to the charity. The charity has a much better idea of what they're going to get in 10 or 15 years. But yet they don't pay any taxes on the gain because they're tax exempt. The perfect opportunity to utilize something out there. And so I think, we talk about a product like an annuity that is very often misunderstood.
For sure.
But when they're used for the appropriate options, they can be very, very useful.
Yeah, for sure. Well, I know we're running out of time here on today's show, but anything specific for the state of Arkansas as it relates to state taxes that folks need to understand?
Right. Well, in the state of Arkansas, with Social Security income is not taxed at all on the state level. We talked earlier about how it can be taxable on the federal level at different income levels, but at the state of Arkansas, it's not taxed. Our income tax have actually dropped to 4.4% for 2024, and then the first $6,000 of retirement income is not taxable in the state of Arkansas for retirees.
Right. So, gosh, so much to know, so much that goes into this. As we have to bring it home on today's show, I think it cannot be stressed enough the importance of looking ahead, being proactive. What do you want to say to our viewers about helping them lower their potential tax bill? Well,
the main thing I want to point out is just to carry over from where Mark finished off is the idea that since certain income is not taxed on the state level, then maybe there's a reason we maximize it. And that's one of the reasons we start with the Social Security maximization strategy to see what those things can look like, how that has an effect on your tax situation, how you structure your investments themselves, what impact they're going to have, because some unforeseen income coming in not only can affect your personal income taxes, it can also affect your Part D portion on your Medicare bill and so many other things. And so if you do not have a defined tax strategy that you're following as part of your overall holistic financial plan, please pick up the phone and give us a call. Come in, let's get this thing sorted out and get you down a good solid path moving forward.
Wonderful. Dale, Mark, thank you so much. Thank you for joining us. We love you, Arkansas. We'll see you next time here on Arkansas Money Talk.